So welcome everybody to the Final Quest bootcamp, right? And it's such an honor to be able to do this together with you. I mean, if you were not here, I'm not sure if I'll be doing this, right? So let's talk about structure, right? The basic part of structure, right? We just want to try as much as possible to keep everything we're going to be talking about very, very simple, right? So one of the things everybody who trades needs to understand is the structure formation of the marketplace, right? You want to really understand the structure formation of the marketplace. And when I say the structure formation of the marketplace, what I'm talking about is how the market actually, so how the market actually forms, right? One of the ways that the market forms. So when we talk about the market structure, there are like three major ways that the market gives to us a market formation, right? We have the bullish trend, we have the bearish trend, and we also have the consolidating market, right? So I'm going to start from bottom to the top. So what I mean bottom to the top. So when you talk about like the three phases of market formation, the first phase of market formation, we have the bullish trend. Then the second phase, we have the bearish trend. And the third phase, we have what we call the consolidating phase, right? So the third phase is what we call the consolidating part of market formation. And this part of the market formation means that when the market is actually consolidating, there is no directional bias. It means that the market does not really have a directional bias in this particular case, right? What the market is actually doing is that the market is actually creating what we call engineering liquidity, right? So anytime you see the market actually consolidating, one of the things you get to see is that the market is actually engineering liquidity, and ICT calls it buy side liquidity being engineered, and also sell side liquidity as well being engineered, right? So buy side liquidity is engineered at the top, right? And sell side liquidity is engineered at the bottom. So one of the things you need to begin to understand for yourself personally is that every time you see the market consolidating, right, it gives to you a message. And the message it gives to you is that the market does not have a directional bias. The market does not have a directional bias, right? So what it means is that it is, so what's, uh, okay, sorry. So what you need to understand, the message that a consolidating market gives to you is that, please, Lars, stop prescribing on the screen, please. Please, this is not fair. Just make it very easy for others, right? So one of the things you need to understand is that whenever the market is actually consolidated, right, and liquidities are actually being engineered, buy side liquidities are engineered, and also sell side liquidities are engineered. So one of the things you now begin to understand is that that is why you hear people always talk about Asian session not being traded, right? There are people who trade Asian session, and the reason why they don't trade Asian session that much is because Asian session is always known to have low volumes of liquidity being injected in the market, meaning that Asian session is always going to consolidate. So whenever Asian session consolidates, two things are always going to be created, right? We have the Asian high liquidity, and we also have the Asian low liquidity, right? These are the two major types of liquidities that you see price creating, right? They are. I must dive in a bit, but I'm trying to make a point. So you will notice that every time Asian session consolidates, right, people are always advised not to trade Asian session. The reason is because many a times, right, many a times, market doesn't really have, Asian session doesn't really have a directional bias. So you have the Asian high, we have the Asian low, right? So the moment the Asian high and the Asian low is being created, we know that liquidity has been engineered at the buy side and also at the sell side. So we expect two things to happen, right? Number one, we expect that Asian high will be taking and Asian low go next, right? Or we expect Asian low to be taking and Asian high is going to be taking next, right? So it gives us a message, right? One of the message that the consolidating market passes across to us is that there is no directional bias, right? Liquidity, a ton of liquidity is being engineered. So you see that this is one of the reasons why I don't bash any form of trading system. There are those who trade just support and resistance, right? So you see that those who trade support and resistance, see this is a place that their own strategy comes in, right? When it touches the first time, yeah, touches the second time, they know the third time that that particular support or that particular resistance is going to hold. So they are going to sell the market down from that support to the next resistance, from the resistance down to the next support, right? So that is how it works. So one of the things you need to know about the consolidated market is that it doesn't have a directional bias. And so you most likely you always want to stay out, right? There are two things you want to expect a consolidating market to do, right? The first one you want to see is what we call the AMD, right? The AMD is what ICT calls the accumulation, manipulation, and distribution. What it means is that after price has accumulated or consolidated, right, we want to see a manipulation, right? That means we want to see a manipulation of one of the sides of the liquidity that has actually been engineered, either the sell side liquidity or the buy side liquidity that was actually engineered. We want to see price actually manipulate either of these liquidities, right? So many times you see that the manipulation, the accumulation, we have the manipulation. The manipulation is what we call a sweep of liquidity. Then we have what we call the distribution, right? That distribution is what leads to a break of structure, right? So you see that price actually breaks a particular structural high that is actually here, right? The moment price breaks that structural high, you know already that we have a trade formation already, right? And this is a trade formation. You know what we call the sweep of liquidity, break of structure with our inducement liquidity that is resting there, right? Please mute your mics, please. Just be kind enough to mute your mics. So what you want to expect is that price comes to take out our internal liquidity, internal range liquidity, or inducement liquidity, and price goes to the next liquidity point, which is the external range liquidity. So whenever you see the market actually consolidating like this, you expect two things to happen. And the first one is what I just showed you. The first one is that you want to see price accumulate, then give to you what we call a manipulation. The manipulation is what we call as, is also what we know as a sweep of liquidity, right? That sweep of liquidity is what creates for us what we call the strong low, right? It is a strong low. So we want to see price accumulate, want to see price manipulate, and want to see price distribute, right? The distribution is what leads to the break of structure. And anytime you see price actually distribute, one of the things you want to know is that it will lead to a break of structure. So the second formation after price begins to accumulate, right? Or price begins to consolidate, right? Don't forget, we're still talking about the three formations of structure, right? So anytime you see price begins to accumulate like this, right? The second thing you want to always expect is what the other retail traders, right, like us, right? Because we're all retail traders, other retail traders like us. The second thing you want to expect is what they call a break and retest, right? So many times you see that price is just going to break a particular low, right? That means you don't really see a manipulation, right? You know, the first formation in a consolidation is going to manipulate, then distribute, right? After the distribution, you have your trade formation, meaning that a strong low has been created, your internal range liquidity has been created, and now you have your external range liquidity. So you know that there are two things that price wants to do, right? Price will bounce off from internal range liquidity straight up to external range liquidity. So the second formation in a consolidating market is that after price consolidates for a very long time, right? The second thing that price does is that price is going to break out, right? It's going to break out from that consolidating phase, right? So one of the things the second thing you always want to see price do is that price is going to break out. So this is what people call the breakout and retest. So after price breaks out, right, there's every likelihood that price is going to come back to the balance and imbalance that was actually left out here, right? Price comes back to rebalance and old imbalance, right? And price continues to give to you that order flow to the downside. So the next thing you begin to see is that this is what people call the breakout and retest, right? And so one of the best ways that you can actually approach a breakout and retest is that after price breaks out from a consolidated market like this, right? After price breaks out from a consolidated market like this, many times you only want to peak from the Asian low, or let's say from the consolidated low to the consolidated high, right? And you want to play like the midpoint, which is like the 50% of that entire market that actually consolidated, right? You want to play like the 50%, meaning that after price has broken out, price comes back to test like the 50%. So from this 50% and above of this consolidated market, you could find like an imbalance, you could find like an order block that needs to be mitigated, you could find like a breaker block. Yeah, you're likely going to find something there, right? Price wants to mitigate and come back and continue to move to this particular direction, right? So this is all you need to know about a market when the market is actually consolidating, right? So like I said, I'm going to start from the bottom to the top, right? So the next thing you now begin to, please don't describe on my screen, please. So the next thing you have the second type of trade formation, right? We've just spoken about the consolidator. So the next one we want to talk about is the bearish formation of structure, right? The bearish formation of structure is when price begins to give you consecutive lower lows and lower highs, lower lows and lower highs, right? Lower lows and lower highs, lower lows and lower highs, lower lows and lower highs, right? So lower lows and lower highs. This is what's actually in a bearish formation like this. This is what actually creates, meaning that price comes back after creating for us a consecutive lower low. Price comes back to mitigate an order block cost. It comes back to rebalance and old imbalance, right? So you see that every time price comes back to maybe mitigate an order block, price comes back to rebalance and old imbalance, right? There are two things I always say to my guys that price seeks to do. The first thing that price seeks to do is to rebalance. There are two things that price seeks to do every time in the marketplace, which you can go back to your charts and study after this call. The first thing you always see price do is that price always wants to attack liquidity, and also price always wants to rebalance and hold imbalance. So when we begin to talk about the advanced structure, you begin to understand what I mean by price doing two things, that is rebalancing and hold imbalance, and also attacking liquidity. So you see that this is when we begin to have what we call the order flow formation. right? The order flow formation, where after price takes out a consecutive lower low, the consecutive lower lows, price comes back to actually mitigate an order block that was responsible for that impulsive move to the downside, right? The impulsive move to the downside that led to the break of this most recent lower low, right? Price comes back to mitigate it, right? The order block that was responsible for that, right? Or price comes back to mitigate maybe a breakout block or whatever it is that is there, or an imbalance, right? And this is a type of the second formation. But one of the things I always like to say is that, which is like a caveat, is that the market is not as picture perfect as this, right? So you're never going to see price, give to you something like this every time, right? This is just theory, right? In fact, when we get to the advanced part of it, you begin to understand, right? Because I'm going to explain to Ross. So how do you begin to know that a trend as like a bearish structure has actually started? So how do we begin to know that a bearish structure has started, right? So one of the ways you begin to know that a bearish structure has started is that price begins to create for you what we call a strong high and a strong low. So one of the ways you begin to know that a bearish structure has actually started is that price is going to create for us what we call strong highs. In a bearish structure, price will create for us what we call a strong high, right? Can we still hear me? Can we hear me?
We can hear you.
Okay, sorry. Thank you. Sorry. Okay. So let's continue. So one of the ways you know that a bearish formation has started is that price begins to create for us what we call a strong high, right? And one of the ways a strong high is created is that price sweeps liquidity and breaks structure. So this is when you know that a trend formation has actually started, right? Because every trend must have what we call a strong high. And one of the ways a strong high is created is that price sweeps liquidity and breaks structure. So the moment price sweeps liquidity and breaks structure, we have a trend formation, right? So price begins to move to the downside, move to the downside. We'll talk about all of this when we get to range cycle. In fact, when you understand structure and you understand range cycle and liquidity, right? I mean, you are good, right? You're good. So the way a structure starts is the same way it ends, meaning that the way it starts is that price sweeps liquidity and breaks structure, and the way it also ends is that price also sweeps liquidity and also breaks structure, right? So this is how a structure is formed, right? A bearish structure. So as it is in a bullish formation, so it is in a bearish as it is in a bearish formation, so it is in a bullish formation, which means that one of the third way a structure is actually formed is that price continues to give to you what we call consecutive higher highs and higher lows and higher highs and higher lows and higher highs and higher lows and higher highs, right? So we know that like this is like a basic and the market is not always going to be picture perfect. So another thing we need to talk about is how do you know that a trend has ended? Like how can a shift in structure actually happen? Which people call the market structure shift, the break of structure, or the church, right? Whichever one you choose to call it. Like I always say, it's not really about the name. It's just you understanding the concept behind what you're talking about. So when you talk about what we call a break of structure just means that price begins to shift its original bias from a bullish trend or a bearish trend to a bullish trend, right? So it's just a break of structure is what we call, or a market structure shift is what we call a shift in the directional bias. So what that means is that the same way this particular structure started is the same way it will end, right? The way it started was that it swept liquidity and broke structure, and the same way it's going to end is that it also swept liquidity and it has also broken structure, right? So now you can see now the moment price breaks structure, you can see how the trend is going to shift until price takes out the next high. So one of the ways you begin to know a break of structure, right? What the primary purpose of break of structure is that this break of structure is just there to let you know that the directional bias is willing to shift its directional bias, right? It wants to shift its directional bias, right? So it's moving its directional bias from a bearish formation to a bullish formation, or from a bullish formation to a bearish formation. So when we talk about break of structure, one of the things I love to emphasize a lot is that a break of structure for me becomes valid when at least it breaks at least two structural points. So what that means is that if price is going to move its directional bias from a bearish trend to a bullish trend, I love to see that price break at least two structural points, right? So in a bearish formation, the consecutive lower highs are like the structural point, right? The consecutive lower highs are the structural point. The reason why I don't trust the one structural point uh, break of structure is because this could serve as this one structural point, this most recent lower high could actually serve as our internal range liquidity. So what price could actually just do is that price is going to take out this particular high and continue to move to the downside, right? So one of the things I love to see is that I love to see price at least break two structural points. right? Break two structural points. Then the moment I see break of two structural points, I know for sure that, okay, yes, we are willing to now change our directional bias to the upside. So what that means is that price is willing to now continue to the upside. So the meaning of a break of structure is that price breaks structure because it wants to shift its directional bias from a bullish trend to a bearish trend. So if you remember what I said here, pay attention to what I just said here, that I don't really like a one structural point break, but that doesn't mean that a market cannot shift its directional bias from bullish to bearish with one structural point break. No, that is not what I'm saying. What I'm saying is that I love to see a two structural point break. It makes it very easy and makes a lot of sense for me to know that, yes, to trust that break of structure that is actually happening. And the reason why I said I don't really trust just one structural point break, right, is not, this is where I now begin to explain it to you. So when we talk about those are like that is like the basic of market structure, right? That is like the basic of market structure. So when we talk about the advanced part of structure, the advanced part of structure is also very, very simple. So what that means is that the way, like, don't forget the way a trend actually starts, the way a structure is being formed is that price sweeps liquidity at the top and also breaks structure, right? So now let's say price continues to move to the downside, right? So one of the things I always like to say is that, like I said from the beginning, the market is never always going to be picture perfect. And like I always said, in a bearish formation, every structural high here is a liquidity point, right? Is there internal range liquidity? There internal range liquidity. Every lower high that is actually created in a bearish formation, right? And don't forget, as it is in a bearish formation, so it is in a bearish formation. So every lower high that is actually being created is an internal range liquidity. So this is the reason why I don't trust a one structural point break, right? And like I said now, from the beginning, I said the market seeks to do two things. Number one, to attack liquidity, and number two, to also rebalance and hold imbalance or mitigate an order block. So one of the things you begin to see is, this is the reason why I don't trust a one structural point break. Like I said, every lower high here they are all internal range liquidity. So if you consider this a break of structure, maybe price takes out this particular high, right? You say, oh, this is a break of structure, right? So now that you are calling this a break of structure, one of the things you might want to do is that you call this place your demand zone or your order block or your imbalance that needs to be rebalanced, right? And the next thing you want to do is that you want to buy from this particular, you are looking to buy from this particular, your point of interest, right? And the beautiful thing about the market is that it's going to show you what you really want to see. So because you are considering this one structural point a break, right? So now you have your order block marked out or your demand zone, whichever thing you want to call it, and price comes into your particular POI. And the beautiful thing about price is price begins to go into your direction. So the moment price begins to go into your direction, you are going to say, you take a screenshot and post it on Twitter or whatever social, and you say, GU running in profit, running in profit. So after you have posted it on WhatsApp, only for you to come back and you see that price has invalidated your stop loss, price has taken out your stop loss, and you're wondering what happened. What just happened here is that in a bearish formation, every lower high is an internal range liquidity. Every lower high is an internal range liquidity. And one of the things that price seeks to do is that price seeks to move from liquidity point to another liquidity point, which means that price moves from internal range liquidity to external range liquidity. So this is the advanced part of market structure. So price comes to take out this internal range liquidity, and what price did was that price came again to take out this external range liquidity. This is the external range liquidity that price has taken. Now the price, those people who got in at the earliest, but those who got in at the wrong side of the market, which were those that were actually buying it, and price moved in their direction, right? What they have done is that they were used to create another liquidity again, another internal range liquidity to again, right? And you remember what I said, right? A bearish formation or a bearish outflow starts by creating a strong high, right? By sweeping liquidity and breaking structure. So you can see we have taken out an internal range liquidity here. So we have another strong high here, right? Those early buyers here that their stops got invalidated, they were used to engineer liquidity, which we call the internal range liquidity, right? So now what will price do? We have a strong high already. So what will price do? Price is going to take out the next strong high and continue to move to the downside, so we are moving from internal range. So that means for us that we are moving from internal range liquidity here to external range liquidity at this point, right? So we are moving from internal range liquidity to external range liquidity. This is where our external range liquidity is. So the advanced part of market structure. So when you talk about the advanced part of market structure, the advanced part of market structure just talks about price coming back to always take out the internal range liquidity, right? Because the market is not going to be picture perfect where it just create lower lows, lower highs. I mean, if it does that, I mean, everybody will make money. So one of the things you need to begin to train your eyes to see is the advanced part of market structure. And the advanced part of market structure, like I said, a trade formation begins to start when you have a sweep of liquidity followed by break of structure. And like I said, it's always best for me that we have a two structural point break, right? The moment we have a sweep of liquidity and a break of structure, right, and we have a consecutive lower, we have a structural point which is a lower high, right? One of the things I always want to see is that price will always come to take out what we call the internal range liquidity, right? Price will come to take out the internal range liquidity, and price will bounce off to the external range liquidity. So price is going to create internal range liquidity again, right? Like this. So you see that there's a difference in the first, when we started talking about structure, there's now a difference. So what did you notice here? What is the difference? You see that from the beginning, price was just when we were talking about the theoretical aspect of structure, right? We're just creating lower highs, lower lows. And like I said, it's never ever going to be picture perfect. So one of the things you now begin to see is that for every lower high that is created in a bearish formation, every lower high is an internal range liquidity. So price begins to do two things. So you train your mind to know that price is coming to do two things. Number one, price is coming to attack liquidity. And number two, price is coming to rebalance an old imbalance or mitigate an order block, right? So what do you see price do here? So now let me begin to explain something for you. There are those in a bearish formation who were actually looking to sell from here, right? They were looking to sell from here. They had this particular point as their point of interest, right? They had this particular point of their point of interest. So in your trading days, early days, all right, you used to hear people say your entry is my stop loss, right? Please, can you mute your mic? The person who just coughed, please mute your mic. So you begin to hear people always say to you that your entry and your stop loss is my entry, right? What they mean by your stop loss is my entry is that when price actually created this particular low and you have your point of interest marked out. So if this is your point of interest, definitely your entry is going to be at this low and your stop loss is just going to be above this high a bit, right? So what I mean by your stop loss is my entry is that they understand that in a bearish formation, in a bullish formation, every structural high is an internal range liquidity. So your entry is here, your entry is here, and your stop loss is just a little bit above here. Only for price to invalidate your stop loss, like you must have seen it experienced a lot of times. Price will invalidate your stop loss by just one pip. And the moment it invalidates your stop loss, price will just continue to move to the downside, right? So I believe that many of us have actually experienced that a lot in our trading. So this is what people say this is what I mean when they say that your stop loss is my entry. So if you look at this particular point, price comes back to take out the internal range liquidity and continues to move to the downside and to this other place again. So what happened here? So there are people who were actually looking, they were actually looking to maybe buy from a particular order block here, right? This particular order block here that people were actually looking to buy from. So what did price do? Price gave them an entry. Price was going in their direction, only for price to invalidate their entry. Took out this particular external range liquidity, which is the concept, the most recent lower low. And the next thing price did was that these people who were buying from this particular point, they were used to engineer liquidity, right, which we call the internal range liquidity. So what did price do, right? Price came back again to take out the internal range liquidity. We have a strong high, and price moves to the external range liquidity. So when it comes to the advanced part of market structure, you begin to understand that what price is actually seeking to do is price is coming to attack liquidity. Which of the liquidity? Price is coming to attack every most recent high. It doesn't have to be every of them, right? But price, you have it at the back of your mind that every lower high in the bearish market formation is an internal range liquidity that price seeks to attack. So let's say, for example, you were looking to sell from a particular point, you were looking to sell from here, right? Just have it at the back of your mind that, oh, we have a sweep of liquidity here. This particular high is going to serve as our internal range liquidity that price is likely going to attack. So what do I want to do? I want to be selling. I only want to be selling at internal range liquidity, which are the most recent lower highs in a bearish market condition. I only want to be selling at these particular highs. I want to be selling at the most recent lower highs, which are going to serve as my internal range liquidity. And I want to be targeting my external range liquidity, which are my most recent lower lows. So this is how you now begin to approach structure, right? You don't approach structure like the conventional way, right? You just want to, it's not always going to be, it's never going to be picture perfect like this, right? Just have it at the back of your mind, like I said today, that the market is always going to be doing two things: attacking liquidity, and also rebalancing an old imbalance. So this gives you an understanding of what we call order flow, right? Because you know where price is coming to attack. So you know that the moment you have a sweep of liquidity, right, and a break of structure, you are just waiting for price to create for you what we call the internal range liquidity. The internal range liquidity is where you want to put your entry at. That is like the advanced part of structure that we're going to be talking about, right? So instead of you just taking a trade, price takes your entry, then it sweeps you out after posting it on social media, right? And all of that. So you begin to understand that every lower high in a bearish market formation is an internal range liquidity that price wants to attack. And every higher low is also an internal range liquidity in a bullish market formation that price needs to attack. So we have a couple of seconds left, right? So that is like the basic and the advance of market structure. So I'm going to end this particular recording right now, and I'll share one more link to let's just look at chart examples as well. So I'm going to be ending this one. So I'll share another link. Don't please try as much as possible to join with them.